Hello there, Investing Putts with you again. I recently opened another trading account. I keep most of my money at Merrill Edge, and I opened a Merrill Edge account with $25,000. So yeah, I've been very pleased with the performance of the poor man's covered call, my Robinhood test account. I think it's very hard for most investors to beat just buying and holding the S&P 500. Implied volatility is very low right now, and stocks just keep marching upward. You can buy a leap option for relatively cheap right now to simulate holding the long stock. And then I sell weekly at the money call options against those leaps. This is called the poor man's covered call strategy. As I showed in my previous video, the poor man's covered call is an excellent hedge. For steadily rising stock price, you don't give up any upside. For sideways or mildly declining stock price, you actually make a reasonable profit with this strategy. What's strange is that Merrill Lynch requires me to open margin account to trade spreads. Poor man's covered call is a diagonal spread. It's a little weird. I don't plan on using the margin, but anyway, it makes it a little harder. So these are the underlying stocks that I'm trading. There are 11 SPDR sector ETFs. I'm holding all of them. I have another 4 stocks: EEM for emerging markets, FXI for China, GLD, the gold ETF, and TLT, the 20+ year maturity US Treasury bond ETF, for a total of 15 holdings. So my goal here is to minimize the correlation between the aggregate portfolio and the SPY and still get reasonable returns. So this matrix shows the correlation of the sector ETFs with the SPY. 4 of the sector ETFs are quite uncorrelated with the SPY. XLP, which is consumer staples, XLE, which is energy, XLRE for real estate, and XLU, which is utilities. Here's the correlation of my other 4 holdings to the SPY. Obviously, EEM and FXI are fairly correlated with the SPY since they're still stock ETFs. However, GLD and TLT have a very low correlation to the SPY and a low correlation to one another. A thing to keep in mind with correlations is that these numbers I'm showing here are all well and good, but during a crash, the correlations all head toward 1. Just when you need them to be uncorrelated, they're correlated. However, studies have shown that GLD and TLT maintain a pretty low correlation to the SPY even during crashes. And of course, cash is uncorrelated, has the opposite correlation to the stock market during a crash. That's one reason I like the poor man's covered call. You can control a lot of shares, but you still maintain a high cash balance. So if there's a crash, your leaps might go to 0, but you'll still be sitting on a big cash pile. That's a hell of a lot better than using margin to buy the shares outright with leverage. You're going to get a margin call. Here's a year-to-date performance of the 15 stocks. You won't be able to understand all 15 curves, but I can just tell you that energy and financials are the top 2 performers, while the treasury bonds and gold have done the worst. If I was to go long on these stocks, it would cost me $148,000. Pretty big investment. I only have a $25,000 account in this case. So of the 15 stocks, 14 are either in a bullish trend or sideways, which is a good setup for the poor man's covered call. The 50-day moving average of FXI is currently below its 200-day moving average, and it's trending downward. So for the time being, I'm trading the poor man's covered put on FXI. I'm trading the poor man's covered call and everything else. So here's the sector allocations. About 40% of these holdings are in the hedges that I previously discussed. Personally, I prefer it to be 50%, and I may tweak that at a later date. So I think the economy is likely to break inflationary or deflationary, or possibly both, in the next year. It's a weird time, and something's going to give. I just don't know which direction. So anyway, I'm hedging deflation with bonds, consumer staples, and utilities. And I hedge inflation with the energy, real estate, and precious metals. The cool thing about leaps is the leverage. In my case, I can control $148,000 in stock with an initial cash investment of $17,500. Of course, there's a risk that my leaps could go to zero, but this is much better than getting a margin call on $148,000 in stock that's declined by 30%. There's no margin calls with leaps, and I can profitably sell covered calls against them as the stock price falls and volatility spikes. And I can also sell the long option and the leaps as well. As they get close to at the money and the volatility spikes, they have a lot of extrinsic value.